Have you ever watched a show where someone buys a collapsing, rundown house and flips it into a sleek, modern home? That same strategy happens on Wall Street, even with billion-dollar space companies. In late 2025, the ultimate financial fixer-upper was a space infrastructure company called Redwire. If you looked at their stock price back then, it looked like a condemned property. The shares had dropped all the way down to around $8. The company was weighed down by what amounted to a toxic mortgage. They had inherited a $100 million IOU that charged them 18% interest. It was the corporate version of discovering hidden leaks in the roof halfway through a project. These are estimate at completion adjustments, which happen when an engineering project ends up being more expensive than originally planned. Just like a major plumbing repair eats into your renovation budget, these extra costs meant that money was leaking out, draining the company's reported profits. Seeing this mess, the original private equity backers decided they wanted out. They began selling off millions of their own shares. When everyday investors saw those insiders running for the exits, they assumed the entire structure was about to collapse. To the casual observer, Redwire looked like a total teardown. But while everyone was focused on the peeling paint, the company was actually pouring a new foundation out of sight. While the financials looked shaky, Redwire was pivoting its strategy toward the specific, difficult physics of where satellites fly. They focused on very low Earth orbit. This is a zone right at the edge of space where the atmosphere drags down normal satellites. Redwire built a specialized craft called SabreSat that actually uses that thin air to stay aloft. Because they mastered that technology, the military selected them for the $151 billion SHIELD contract, which is essentially a list of pre-approved suppliers for the country's defense network. That access turned into a massive backlog. These are legally binding future orders that were stacking up to nearly $500 million. If Redwire is our flipped house, that $498 million backlog is a list of guaranteed tenants who have already signed their leases. By locking in that future cash flow, Redwire repaired its internal structure. They had a finished product, and they were just waiting for the neighborhood to heat up. In May 2026, the entire market shifted when SpaceX announced its historic IPO filing. The excitement was massive. It was like a $1 trillion mega mansion being built right in Redwire's neighborhood, turning all the surrounding houses into gold. But there was a catch. Investors wanted to buy SpaceX immediately, but the shares weren't available for several weeks. This forced a sector rotation. Since the mansion was locked, that investment money flowed into other space companies already available. Retail investors felt the fear of missing out and rushed to buy anything related to the space industry. On this wave of hype, Redwire's stock price shot up over 225%, hitting $22 a share. The company had done the work to fix its business, but this sudden price jump was driven by the frenzy of the neighborhood. Now, if you're looking at that chart, you have to ask, is Redwire actually worth buying at $22? The house still has some hidden bills, specifically a $90 million bank loan that has to be paid or refinanced by 2027. To raise that cash, the company might use an at-the-market offering, which creates something called dilution. Think of it like a pizza. If you have a pizza cut into 8 slices and the owner suddenly cuts it into 16, you still have the same amount of food, but your individual slice is half the size. By issuing new shares to raise money, the company makes your portion of the business smaller. While exchanging those new slices for cash helps pay off that 2027 debt, it means current investors own a smaller piece of the pie, which limits how much they can profit later. Buying Redwire at $22 means you're paying the highest possible price for a house that might still require a second mortgage. In 3 years, Redwire repaired its operations, secured government contracts, and stabilized its foundation. But even a successful corporate turnaround doesn't always make the stock a safe buy at any price. Sometimes the smartest move is to wait for the hype to cool down. If you want to understand the real-world mechanics behind these market moves, hit that subscribe button.